Welcome to the Saffery budget briefing. My name's Adam Kay. I'm a partner in the tax team at Saffery in London. This, as a bit of a sort of housekeeping, the webinar is being recorded. It's a hybrid event, so we have people live and people online. The recording will be on the website for a year. No, you can't be seen or heard, whether you're here live or whether you're online. Unfortunately, we can't do questions during the seminar. If you are in person, I'm sure Saffery's partner will be available for a coffee and a donut afterwards to have a chat. Otherwise, you can email me or your normal Saffery contact or events@Saffery, and we'll pick it up and we can help you. If you enjoy the webinar so much you want to see it again, perhaps share it with your loved ones, your children. The recording will be on the website within 24 hours, and we'll send you a link so you can enjoy it at your leisure. The Chancellor said yesterday during his speech that the economy was turning a corner. Given that 5 minutes later he said that growth in the UK was going to be 0.8% this year, and the IFS said that the picture on living standards remains dismal, I can only conclude it has the turning circle of an oil tanker. But nevertheless, there were a number of announcements yesterday on tax and spending, and we're sort of going to cover them today. It was quite an odd budget. Normally when we prepare these things, we have the sort of team going through them, and it's a bit like sort of panning for gold. There's lots and lots of announcements, huge amounts of paperwork, and we try to find things that you'll be interested in amongst that. Whereas here we had a few great big lumps of the stuff and then very little else. There's like 9 things I'm going to be, maybe 10 things I'm going to be talking about today, and there aren't many other things that we could have put in. So if I can sort of switch metaphors for a moment, it was a sort of narrow and deep budget rather than a shallow and wide budget. So we're going to be talking about personal tax. There's lots to talk about in personal tax. There's a little bit to talk about in business tax. There's virtually nothing to talk about with corporate tax and tax admin. And there's a few sort of missing in action points. There we go. So the main event, which you've probably all read about in the paper, and it's probably a given that our webinar attendees jumped up by 300 people yesterday after the Chancellor sat down. A number of you are probably here for the reform of the taxation of non-domiciled individuals. To give a little bit of background before we start, the rules are about 200 years old, and they started out because in the sort of colonial era, if a gentleman had a plantation in the West Indies, it was very difficult for the Inland Revenue to find out about it. And so a set of rules grew up about overseas income. The way it currently works now, i.e. today, is that the rules apply to non-domiciled individuals. A domicile is distinct from residence. Your residence is where you live. Your domicile is where your heart is. If I move to France tomorrow, I'll still be a Brit living in France because my heart is British. And so we have some rules which apply to people who are from abroad, who feel a deep connection to abroad, and that's where their home, their long-term home is, who are coming to the UK for a temporary purpose. And they can get broadly 2 things at the moment. Firstly, they can claim for the remittance basis of tax, which means that they're only taxed on their offshore income if and to the extent they bring it in, and also their inheritance tax, their liability to inheritance tax is on UK assets only. So that's the rules as they stand for now. You can get that treatment for up to 15 years. You might have to pay for it after a while, but broadly it lasts for 15 years. The rules have not been fit for purpose for many years, and some reform has been long overdue. And there's 2 things which are wrong with the rules as they stand. Firstly, the rules are intended to incentivize wealthy people to come to the UK. That is seen as a public good and something that we want to do. So we have these rules which give them a beneficial tax treatment, but we don't let them bring their money here. They have to leave it offshore or they're going to be taxed on their offshore income. So that's backwards, isn't it? We should be encouraging people to come to the UK and to spend their money here to make Britain a wealthier place. The second is that it's incredibly complicated. If one of our clients brings £100,000 to the UK, just picking a number, then we need to know whether that represents untaxed offshore income or not. And to do that, you get these sort of giga spreadsheets which track a dividend received by your client in 2015, which they then paid into an offshore bank account, which they then invested in a property, which they subsequently sold, which they gifted to their sister, and their sister brought it in. That's the sort of stuff which we have to track on a pound for pound basis. It's very expensive. It's very complicated. This, if you can see it, is a picture of the taxation of non-residents and foreign domiciliaries by James Kessler KC, which is the sort of the Bible for this stuff. There is 8 volumes of it there with a satsuma, which I then ate for scale. But it gives you an idea of how complicated the rules are. That is 8 satsuma-sized, it's somewhat embarrassingly, it's last year's edition, because we're online only these days, of course. Nevertheless, there you go. That is an indication of the rules and the complexity. It is fearsome stuff. It's worth having a bit of a think about. There we are. Okay, hopefully, yeah. Possibly that didn't come up when I was talking about the reform of no, never mind. There it is. There's the book. So anyway, it's worth having a think about where this sets us internationally. So there are tax havens such as Monaco and Dubai, which have 0 tax. There are some jurisdictions which have an exemption for overseas income that you have to pay for, like Italy, Switzerland, places like that. Both of those are more generous than us currently. For overseas persons, but neither of them prevent people bringing their wealth on shore. Ireland has very similar rules to us, but didn't reform them as we did in 2008 and 2016, so they are more generous than our rules, only just. And then you have sort of low or flat tax jurisdictions, such as Portugal, Spain, bits of the US, places like that. So currently we're sort of between the bottom 2 of those. We're sort of between Ireland and Portugal, and Ireland and Spain in terms of what we offer to overseas persons. What was announced yesterday brings us just below sort of Monaco and Dubai for 4 years. So it is very beneficial, but huge caveats there, and we'll talk about it. There we go. Right. Okay. So there's a slight delay on when I press the button. Good. When we do these slides, we sort of spend the time yesterday sort of going through the legislation, reading everything, having a big old think, and we send the slides out, and then I practiced them last night and I practiced them this morning, and with a sort of mounting sense of horror, I realized that how boring this talk is likely to be. Because there are lots and lots of rules. It's very dry, it's very technical, and it's not really very clear how it all fits together. I have 3 teenage daughters, and one of the delights of teenagers is they teach you things. And what I have learned from my daughters recently is how much I dislike being called mate. So, you know, Josephine, please tidy your room. Yes, mate. Appalling. Anyway, when the Chancellor said yesterday that this had been the subject of careful consideration over many months, I burst out, yeah, right, mate, because this has obviously been put together at the last minute and it doesn't really hang together in any coherent way. But I'm just going to go through it, and at the end, I will tell you what I think. And please do bear in mind that is on sort of 4 hours sleep and a lot of coffee, but I'll let you know what I think maybe clients should be considering doing. Lots of very clever people are going to be looking at this over the next year, and so that will probably evolve. And there's some big caveats about implementation, but yeah, I'll let you know what I think. So the proposal is to abolish the remittance basis from the 6th of April 2025 and replace it with a 4-year FIG regime. That sounds like the diet my wife put me on at the end of last year, but actually a 4-year FIG regime is an exemption for foreign income and gains, which lasts for 4 years. It applies to qualifying persons, i.e. people who've not previously been resident for 10 years. And so if you've come to the UK and you've not previously been resident, you then have 4 years where you are not taxable at all on your foreign income and gains. You can bring it in, you can leave it offshore, it does not matter, you are not taxed on it. If you are already resident in the UK at 6th of April 2025, the rules will still apply to you, but you may have already started or indeed finished your 4 years. So if a client came to the UK in the most recent tax year, in 23-24, that's their first year. They've got another year, 24-25, where they can claim the remittance basis. And then when the rules kick in on sort of D-Day or whatever we're going to call it on 6th of April 2025, they've got 2 years of FIG regime left before there's nothing, before you're just taxed as a normal individual, a normal Brit. So it's also one of the areas we're going to have to look at quite carefully is for those individuals or people who are already here, what happens to your unremitted income? So if you've already got income, or you're going to have it until 2025, and that's being held offshore and you've claimed a remittance basis, probably we're going to have some sort of requirement to track remittances for that. So we're going to have to segregate post-25 and pre-25 income, make sure that we're remitting the right thing, all of that sort of stuff. So for people who are here already, we're still going to have all of this complexity that we have in respect of existing income. It's likely to be an opt-in basis, so you're probably going to have to elect for the regime while you're here, probably a tax return. People doing tax returns always critically important for the remittance basis, going to remain so. Overseas workday relief is a relief which applies where you come to the UK. It applies for 3 years, not 4. And normally your employment duties are treated as UK income. But for the first 3 years, you're allowed to apportion it. So say, for example, you're a business person and you spend 60% of your working life in the UK, 40% of your working life abroad, then for the first 3 years, 40% of your income is treated as offshore income, so you get it paid into a separate bank account, you don't remit it, stuff like that. They're going to keep that, which is very, very positive. So again, a hugely attractive regime for individuals coming to the UK for the first 4 years. If you look at industries that's going to benefit, footballers, for example, hugely beneficial for footballers who get paid part of their salary in respect of the league, I understand, and they might get a bonus for winning the Champions League or something like that. That's overseas duties because the final is usually abroad. So they'll be able to, if that's in the first 4 years or first 3 years of residence, they'll be able to have that tax-free. So, really attractive tax regime for people like that on a short-term basis. If you are UK tax resident on the 6th of April 2025 and a non-dom, and you sell an asset after that, an overseas asset after that, you will be allowed rebasing to 2019 for some reason. I know why they've picked 2019, because that's what they rebased capital gains on UK residential property for non-residents to, but that has nothing to do with non-doms. So why they've picked 2019, it's just, again, it looks like they've just plucked the date out of the air, but nevertheless, there it is. That will not apply to assets in trust. And that's important because we're getting mixed messages on trusts in this, and I'll cover that in a minute. But that's an indication that you might not want to have capital assets standing at a gain in trust. What you do about that is more difficult, but there you are. So sort of continuing on trusts. One of the ways that individuals who have been in the UK for more than 15 years can extend the benefit of the remittance basis is they settle something called a protected trust. And they can be the beneficiary, they can be the settlor, but it means that assets within the trust remain outside the UK, overseas assets remain outside the UK tax net even after the 15 years is up. It's called a protected trust. It's been absolutely standard since 2017 for everyone who is coming up to their 15 years. Those will no longer be effective. So as well as you not getting the rebasing for your protected trust, you as the settlor are going to be taxed on the income and gains, all of the income and gains in the trust after 6th of April 2025. So not really beneficial at all. I cannot believe that will apply if you've been excluded from benefit. I cannot believe that, but it doesn't say it in the documents. So we're going to have a really good look at, do we exclude settlors from benefit? What can we do there to protect those trusts? Because there's not an easy answer for protected trusts at the moment. It's also going to be necessary, as I said earlier, to match pre and post April 25 income in the trust. So you can think of a world in which, okay, you've got some income that's been taxed on the settlor, you can pay that income out without a tax liability. But if you pay pre-April 25 income out, you will have a tax liability. So it's that sort of internal accounting, which we do a lot of at the moment, and it's going to be just as important post-April 25. And then there's a couple of transitional rules which apply for people already here. So if you're a non-qualifying individual, i.e. you've been here for more than 4 years, or you weren't here for 10. So I've got a client who was originally non-dom, came to the UK for a couple of years to work, went away to reset his domicile for 6 years, now come back. He is a non-qualifying individual, and I haven't spoken to him yet, but I doubt he's super chuffed this morning. that individual will be on the arising basis from 6th of April 2025. There is a one-off 50% income exemption for 25-26, so he will only be taxed on 50% of his offshore income that year, not his gains. So again, you can sort of get a headache trying to think, well, okay, that means that dividends are going to be taxed at a lower rate than capital gains, so he should be taking, so there's all of that sort of stuff to work through. There's also, and this is quite positive for people who've got a lot of unremitted offshore income, there's going to be a temporary repatriation facility for 2 years, where if you remit, you have a flat rate of tax of 12. So again, that's it's not great because there's potentially quite a big tax hit, but it's at 12%. So an opportunity to repatriate stuff in those 2 years. Couple more slides on this. Apologies, do stay with me. So inheritance tax, currently on the, press the button, there we go. This is terrifying that it only works sometimes when I press the button. So inheritance tax will no longer be based on domicile, but based on residence. Broadly, it looks like there isn't going to be too much change to the current system, but after 10 years, you will be liable on your worldwide assets rather than 15. And there'll also be a 10-year tail when you go non-res. It doesn't apply to UK assets. And the last point is about mixed messages on trusts. The document, the technical document, says excluded property trusts will still be effective if funds are settled before 6th of April 2025. So currently, these protected trusts are also effective for inheritance tax. So on the direct tax, the CGT and the income tax side, we're worried about trusts as potentially being inferior to a direct holding in some cases. But on the inheritance tax side, they look much better. They look like an attractive vehicle for a non-dom. So we're going to have to watch that through the consultation to see what happens. But for many clients, it will still be beneficial to set up an offshore trust if they do it prior to 6th of April 2025. And so that is that's a really difficult point. And that comes on to the next slide. And the last point there, I think, is the most important, which is that the Tories probably won't be in power on 6th of April 2025. So although we have a set of rules and principles and the technical note has said certain things, this is not the end of the story. And you can't view it like legislation. We don't even have any draft legislation, but you can't, the final form of the rules will probably be very different. I think it's quite unlikely that the Labour Party would row back on this, but they may reduce how attractive the first 4 years are. They may make it a 3-year fig rather than a 4-year fig. I do not know. They may row back on the point about excluded property trust being beneficial. So it's really going to be a very difficult year. In particular, the first 2 points there, the excluded property trusts still look like they're beneficial, but doing one before the election will probably be quite punchy. And if you go to your solicitor in March and say, I need an excluded property trust, please, before 6th of April, given that they'll be doing quite a lot of these at that time, I would have thought, they may tell you to, well, they might decline. And so in that case, there's going to be a very difficult sort of question that people need to ask themselves about when they take action on this. What should people do? So if you've been here for more than 4 years and you're a non-dom, or you will have been here for more than 4 years in April 2025, if you've got rights to, if you've got future income that's going to be paid after April 2025, there is not much you can do about that. Accelerating income is going to be basic tax planning for us now, both in terms of prior to April 25, so that you can get the income out of your trust, of your structure, loan it back, and then just take loan repayments in the future. Maybe there's going to be some planning like that. Rebasing of assets might well be beneficial pre-April 2025 if the final legislation keeps mixed fund rules. If you sell it before 2025, you lose the 2019 rebasing, but you'll rebase to 2024, which might be a higher number. And as long as you can keep that gain offshore, and we'll need to look at how the rules work, that might be more beneficial when there's a subsequent sale, because you might only be able to withdraw the post-24 gain. So there's a lot of that sort of planning, where someone going forward, where someone comes to the UK, does their 4 years, and is looking for planning at the end of that. Rebasing will be absolutely standard planning. Everyone will do it, and it will be so common that it would be great if this came up during the consultation period and they gave us an election, because otherwise we'll have to do it every time, and for every asset. It would be great to have an election just to save the amount of professional work that it will take, but we'll see if we get that. Aside from trusts, the other thing that people need to be thinking about doing is repatriating. That 12% is still 12%, so it's tax, but it's much more beneficial than you would get subsequently. If you're going to be here for a long time and you think you might need that money, remitting it is probably a good idea. Aside from that, I think we're just going to have to look as the consultation period progresses. The date of arrival in the UK is critically important. There's a lot of talk about 4 years. We don't know whether that means calendar years or tax years. I suspect it means tax years. So if someone came to the UK on 1st of January this year, that 3-month period is one of their 4 years. That's how it works for overseas workday relief. That is how I imagine it will work here. So planning the time, even if you claim the split year basis, you're probably going to take up one of your years. So planning the time of arrival is going to be much more important than it currently is. It's already very important. It's going to be even more important for that 4-year period. The other thing is worth thinking about is treaty non-residents, because for some parts of the statutory residence test, if you're resident in the UK but not resident somewhere, but also resident somewhere else, and you tie break under the treaty, that's treated as non-residents for the statutory residence test. So how will that work? If you're treaty non-resident, does that mean that you're not a qualifying person? There's quite a lot of work to have a look at there. But subject to that last point, that it's going to be potentially a Labour Party Chancellor that enacts this in a year's time. One last thing, and I'm going to stray into politics slightly here, so apologies, that the Labour Party manifesto, such as it is very light on detail, but is very broadly some limited public sector improvements funded by tax rises, and those tax rises have been calibrated not to scare off Middle England. And so one of them was this, and the other one was the energy windfall levy extension, which was also announced by the government yesterday. Didn't get a lot of press, but it's in there. So two of the big Labour tax rising announcements have been nicked, by the Conservatives and used to fund a tax cut, which Labour have said they will keep. So if Labour are now in a difficult position because they're either going to have to amend their manifesto or think of more tax rises to fund it. So I think, this is my personal opinion, this is not a Saffery view, that this means that VAT on private school fees is even more likely than it otherwise was. I imagine we will also get the mooted change to the taxation of carried interest. Carried interest currently taxed at 28% on gains. I imagine we'll be nudging that a bit higher under a Labour government, because they'll be wanting to raise, I think it was it 2 or 3 billion that would potentially raise. So that could sort of matches what they've lost on non-doms quite neatly. So and other stuff, they're going to go after APR, worth having a think. In general, going forward, the UK is an extremely, if these rules come in, the UK is going to be an extremely attractive jurisdiction from a tax perspective for the first 4 years, right up there with any other around the world. And after that, there is nothing. So after 4 years, there is very, very little. There's some tax planning you can do. It changes the UK's international offering. For clients, we've already had a couple of clients talk about moving to Italy since yesterday, but also international commuting might well be a thing. It's very easy to spend 3 days in the UK now and not be tax resident. That's 2 nights. That's less than 19 midnights in a year. Maybe that's the sort of thing that will be more common. And on that cheerful note, let's move on. So there was another little thing on international tax, which came in yesterday, which was the transfer of assets abroad. This is a legislation which stops people setting up companies offshore to hide income. If I set up a company in the Isle of Man and use that to receive my investment income, if I had any investment income, then that income would then be taxed on me under the transfer of assets abroad rules. HMRC lost a case a couple of years ago called Fisher, which said that if in order to for the legislation to bite, you need to be able to identify a transferor, and in Fisher, a company was allegedly the transferor, and so the rules couldn't apply. So Fisher said you couldn't have a corporate transferor because it was the directors making the transfer, not the shareholders. There's a separation of powers. And so unless you have a sort of shadow director role or something like that, it's also difficult to split the transfer between the shareholders. So for income arising on or after 6th of April, companies will be able to be transferors. It'll apply to closely held companies such that it will be treated as being made by an individual with a qualifying interest, where the individual will have received a capital sum as a result of the relevant transactions, which is absolute gobbledygook. The use of the future perfect tense, they're extremely unhelpful, but you're looking at closely held overseas companies, and more detail needed. The other big thing that came in yesterday that you may have seen or probably have seen is the national insurance rate cut. So this is a second cut. It's the first line of your handout, say the basic rate will be cut from 10% to 8% from 6th of January 2024. The actual date, which is correct up there, is April 2024, after the 2% fall in January. So that's a 4% decline or fall cut in Class 1 employees NIC since April 23. Likewise, a 2% cut for self-employed, including partners and professional service firms, which is jolly welcome, in addition to the 1% previously announced. Higher rate at 2%, and looks like employer contributions. There's not very much detail about those at all, but it looks like they're staying at 13.8. They've already announced that Class 2 NIC is being abolished from 6th of April 2024, so you don't have to pay it, but they're struggling to actually work out how legally to abolish it. They're still struggling, but that is still the intention. So what does this mean? The maximum saving for an employee is £754 a year, so about 1,500 quid for over the two cuts. Weirdly, this might have an effect on IR35. It makes it quite close now as to whether or not to take dividends or salary from a company. The continuing employer's NIC charge is still there. That's now the difference, but it's likely to reduce people relying on IR35. The Chancellor stated in an interview afterwards to the BBC yesterday that it remained his plan to abolish NIC in the coming years, which I thought was sort of heartening self-confidence in the likely election result. But nevertheless, he still has a long-term plan for NIC. You need to bear in mind the fact that they're not increasing rates and bands for the tax bands until 2028, I think it is. And the Institute of Fiscal Studies said yesterday, they put a chart, which I wasn't sure if I was allowed to use, so I've left it out, unfortunately, but only people earning between 52,000 and 32 and 55,000 will be better off by 2028. For everyone else, the NIC cut gets eaten up by your increase in your fiscal drag on your earnings. A couple more things on personal tax. So we have CGT on property. Those are the current rates of CGT on property. So 10 or 20% for normal assets, resi and carry 18 or 28, and business asset disposal relief gives you 10. And there is a very small change, just sort of spot the difference there. I don't know if you can do it, you can see it, but the main rate of residential property is going to drop from 28 to 24, which apparently is going to raise 300 million pounds a year from cutting a rate of tax. I've never heard a client say to me, I'm not going to sell my residential property because the tax rate's 28. I would do if it was 24. But nevertheless, lots and lots of people are just waiting for exactly this moment to realize their residential property. So that's probably a lot of people. So I'm sure they'll be delighted by that. Bear in mind, though, that the annual exemption drops from £6,000 to 3 with effect from 6th of April 2024 as well. Moving on to the high income child benefit charge. We often have in tax a conflict between things that are fair and things that are simple. Trying to make things fairer tends to make life more complicated. A flat rate of tax where everyone pays 20% on everything would be quite simple, but arguably not unfair. And so we go on. And so George Osborne had a big think in 2013 about whether it was right that everyone in the UK should receive child benefit, which, given that it was intended for sort of struggling families, is it right that the so-called rich should receive it? And he gave a hard no to that and introduced the high income child benefit charge, whereby the higher earner in a household has an extra tax charge every year in their tax return, which recovers to recover or withdraw their child benefit. It is a complete Horlicks, I would say, of legislation, and essentially there's four problems with it. One is the way it's been implemented. It applies on a household, on an individual basis. So if you have a house with two parents earning 49 grand each, they receive child benefit. If you have a house with one parent earning 60, they do not. So that's obviously wrong. But nevertheless, that's what the legislation says. Second is that people don't know about it. 20,000 people were given penalties for failure to pay CIBC in HICBC, in the 4 years ending 22-23. So say £200 to £300, depending on the penalty. That's about 5 million quid of penalties paid so far in those 4 years. There were nudge letters, which I certainly didn't get, but apparently there were in 2013. But I'm not aware of any since then. People just don't know about it. The third is that the simplest solution is the wrong one. So the simplest solution is for the person who would otherwise receive child benefit to say that they don't want to receive it anymore, and then you don't have to bother with any of this. That's what we do in our house. But that's the wrong answer, because if you are a non-earning spouse, receipt of the child benefit is earnings for pension entitlement. So if you are a non-earning spouse and you elect not to receive the child benefit, you lose earnings years and you lose part of your pension. The right answer is to pay it and then for the earning spouse to give it back in their tax return. So complexity for no good reason. The Chancellor said a year ago that they were going to sort that out. He said it in the budget last year. We've not seen anything yet. I'm not aware of seeing anything yet. And the last thing is, well, aside from the good thing about the high income child benefit charge, actually, just looking at the people don't know about it thing, is it's given rise to a fascinating area of tax law, which I think is fascinating, but everyone else thinks is boring, as to whether or not it's a tax, because there's a huge number of cases about whether or not HMRC can issue a valid assessment. Anyway, sorry, I'll move on. That's just me. Sorry. Anyway, so that is just me. Okay, the tax rates. This is a chart which was done by Tax Policy Associates, a think tank. So thank you to them for letting me use it. This is the tax rate for a single earner with a family of 3, and you can see they are up at about 30%. Once for tax in an eye, they leap up to just over 70%. While their child benefits withdrawn, and then they go up again when the personal allowance is withdrawn, and then they settle back at 45%. So that's just obviously counterintuitive. But the effective tax rate that individual will pay before yesterday's NI cut's about 70%. You can do better than that if you have more kids. If you have 8 children, you are taxed at an effective rate of 110%, between 50% and 60%. If you take into account the fact if you're paying a student loan, you have to include at the 9% effective graduate tax on top of that, which takes you to about 120% tax if you've got 8 children and paying a student loan, which you probably are if you're between that. If you take into account the fact that the government announced free childcare last year for people earning less than £100,000, which is just taken away in a cliff edge once you get to 100 grand. If you say that childcare is worth 20 grand a year, which it is in London, then the effective tax rate on someone going between £99,999 and £100,000 is 20,000% for that £1 of additional income. So if you have staff, which we do, with children we're giving a pay rise to go above £100,000, that is very, very counterproductive, and you should not be doing that. There you go. So the proposal is to move to a household-based system. So that removes one of those bits of unfairness, i.e. that the 2 49,000ers will get it and the 60 won't. That's apparently going to take 2 years and cost about £3 million of new IT costs for the HMRC to upgrade their system. Funnily enough, they can detect if you haven't paid it on the basis that that's a person living with you has got a high earning, they've already got the ability to detect it and give you a penalty, but nevertheless they can't remove the charge. So that's where the 2.7 million quid will go. In the meantime, they're deferring the start of the taper from 50 to 60 grand, and it tapers over 20 years. So you still have to repay the same amount, but your marginal rate drops by about 10%. I think 10%, yeah, in that period, I think. So it does nothing for you if you earn more than 80k, but it removes one unfairness in the system. So that's it on income tax, and we've had a jolly good time. I've got about 10 minutes left to sort of canter through the other announcements. The big one for me, the most exciting one for me yesterday was not the non-domicile rules, but the abolition of multiple dwellings relief. So normally if you buy more than one property in a single transaction, you pay, so if you buy 2 houses for £1 million, you pay SDLT on £1 million. You get one nil rate band, one set of lower rate bands, you pay tax on the lot. There is an election you can make, or claim you can make for relief, multiple dwellings relief, to say you pay tax on the average amount. So you say you're buying 2 houses for £1 million, you pay on 2 lots of 500 grand instead. It's usually quite beneficial because you get two nil rate bands, 2 lots of lower rates. It was intended to benefit property developers. Actually, 95% of the cases we see are wealthy individuals buying houses with granny flats or annexes in the country. And so the government has been thinking about amending it for a couple of years, actually drafted some legislation, but have decided just to abolish it with effect from 1st of June 2024. There will be transitional rules if your contract has exchanged before that date. So normally you pay SDLT on completion. If you can exchange before the 1st of June 24 and then you don't do anything to your contract, that's really important. You can't amend your contract later. The transitional rules are quite strict. Then you will still get it. So there'll be a rush for people to complete those sort of property transactions before June 2024. For student housing purchases are the main sort of beneficiaries of MDR in terms of quantum. The way that student housing works is that when you make an MDR claim, your rate of SDLT is normally about 1%, and now it's going to be at least 5%. So those guys are not in a great position. There is engagement offered with farmers. I'm not sure why, but nevertheless, what that's likely to we may get something. That's slightly odd because if you're buying a farm, normally you pay non-resi SDLT, so you're paying 5%. It's quite rare for a farmer to pay at sort of residential rates, so that's slightly odd, but nevertheless, that's there. Also bear in mind that it's still in place in Scotland and Wales. I cannot believe that they will leave it in place in Wales because they normally follow whatever happens in England, and also the issues are similar. In Scotland, because of the way the additional property surcharge works, maybe they'll leave it. I don't know, but bear in mind that it's still going to be there for Scotland and Wales. The other big thing for farmers is APR for environmental land management. So agricultural property relief is a relief from inheritance tax, which applies where land is occupied for agricultural purposes. So farming. Over the last few years, farmers have been encouraged to diversify their income stream, to move into, as sort of basic payment schemes fallen away, as the sort of subsidies have fallen away. And one of the most lucrative things that farmers can do is to offer up their land for things like biodiversity net gain. So if a property developer wants to build houses, the legislation requires them to demonstrate that they've increased overall UK biodiversity, despite the fact they've concreted over a big chunk of it. And so they do that by finding a local landowner and improving part of their land. And so they'll pay the landowner to take their land out of farming and build sort of plant wildflowers, plant trees, encourage animals to go and live there. And it can be very valuable. But there is a concern that it's not agricultural use, and therefore you won't get APR on it. Quite often with a farm, you might get agricultural tax relief or business property relief. So the question we've been asking ourselves as advisors is, do our clients get business property relief for these biodiversity schemes or carbon capture schemes? And a bit tricky. You have to look at the services provided. There's no special rules. Slightly concerned that our clients will have inheritance tax implication, sort of exposure when they use these schemes. So we have a very welcome extension of APR to land managed under an environmental agreement with an approved responsible body. So that's really positive. The issue that we have for our clients is that currently there's a sort of patchwork of little regional schemes or corporate schemes which may not qualify for this. So what we'll need to do is go and look at what our clients are doing and see if they're going to fall within APR. So if Shell have come to one of our farmers and said, you know, we'd like you to do a carbon capture scheme on your land, well, they're not going to be a responsible body. So can we bring that scheme into this APR? So it applies to transfers, i.e. deaths or lifetime transfers on or after 6th of April 2025. There is absolutely nothing in the press release about 10-year charges or exit charges from trusts. We assume it will also apply to those. It would be mad if it didn't, but you know, it's not there, so we'll have to have a look. The other thing on APR, just sort of banging it in at the end, is bear in mind that from 6th of April, it's being restricted to UK land, so Channel Islands land and EU land will no longer qualify. Is that one? Oh, business tax. Okay, so do bear with me. I know it's warm in here. We're sort of cantering towards the end. That's to continue the farming chat. Furnished holiday lets. Currently, if you run an FHL, you're entitled to some tax benefits. Not quite as good as they used to be, but there are some tax benefits. You can get business asset disposal relief sometimes on a sale. You can get a better slate of capital allowances than you can if you're a normal renter. Critically, you don't get restricted relief for mortgage costs, which you do if you're a sort of normal lender. And although this rarely comes up, it's relevant earnings for pension contributions as well. So that's going. With effect from April 2025, there are no technical notes produced. We just have a paragraph in the documents, and there are going to be anti-forestalling rules to say, okay, well, let's trigger we might otherwise wish to trigger a capital gain now to bake in your CGT treatment. There might still be some planning there, which is doable. Haven't seen the details yet. Normally, planning works if you irrevocably create a tax charge. So if you're willing to take a bit of tax risk, there may be some planning that can do there. Because we don't have technical details yet, which is quite frustrating, we don't know what they're going to do on things like losses. If you've got losses, effectively you're going to be ceasing to trade. So are those losses going to be wasted? Will they turn into property losses? We don't know. Bear in mind that it doesn't affect IHT. There's no mention of IHT here. There are no special rules for inheritance tax for FHLs. You have to demonstrate that what you're doing is over and above a rental business and you've got extra services. There was lots of people have tried to take cases. I think there's been one win, possibly two, and most of them have been lost. So people are still having a go with inheritance tax on FHLs. And the final thing here is if you have got clients or you have geared FHL investments, be really careful about interest. The way that interest is restricted for rental properties, which they may not be aware of, or you may not be aware of, is very penal and can turn a profitable rental activity into a loss once you factor in the tax, and you don't get relief for that loss. So it's really worth getting the sort of calculator out and working out what the effective change of interest will do to you. VAT. There you go. Registration threshold up to 90 grand. I cannot remember the last time it's changed. I couldn't find it this morning when I was frantically trying to make my notes for the slides, but the registration threshold will be up to 90,000, which will be a benefit to the very large number of businesses who have previously had an £84,999 turnover for every year for the last 10 years. They'll now have an £89,999 turnover. Corporation tax, one point to make on corporation tax is creative sector tax reliefs. So the UK has a very generous tax system for creative sector companies. We're a sort of, not a world leader because we're probably behind the US, but I think we're the second biggest film industry in the world. It applies to film, animation, video games, things like that. We had significant changes last year. We have 3 changes this year. One is a new credit for UK independent films, so films with a budget of up to 15 million, and that's worth 39.75% of net of tax, up from 25.5. So for a film, I did some maths, for about a film with a 12.5 million budget, that's 1.4 million of extra tax help. That's not the total, that's the extra that the new credit will benefit. Do bear in mind that if you go £1 over the 15 million budget, you will lose the increased credit. There's a cliff edge there. So again, lots of films will be costing £14.999 million, I imagine. Films, to benefit from the credit, they already need to be culturally British. I understand that there's going to be some additional requirements to access this. I think you need a British director or producer, or it needs to be a co-production, I believe. But yeah, so anyway, that's a positive change for the film sector. Then there we go. Visual effects companies. So currently there is a cap. So if you spend money on a creative sector project in the UK, you can only get credit for up to 80% of your costs. So you may as well, and what sometimes people do is take the extra 20% and they do that in another country and they claim some overseas, under the other country's rules, credit for the remaining 20. It's quite hard to do with film, but it's very easy to do with visual effects because it's portable and people can work very easily across borders. That's going to be removed, which is very positive. And as I understand, will according to the UK Screen Alliance, will lead to about 2,800 new jobs in the UK, which is jolly nice for them. Museum and gallery reliefs, the sunset clause is being removed, and also we're getting a sort of 40 or 45% rates going forward. So again, generous rates of credit for theatre, museum, gallery, and orchestra exhibitions and tours. There you go. We had quite a lot of change on this last year, and that's still working through the consultation. The big thing is going to be connected company transactions. So if you use if you own a studio in the UK and you rent it to the film development company, what rent is allowed to be used, what rent's allowed to be charged. If you're making a big movie and you're lending your IP to the movie, so if you're making a superhero film and you've got Marvel IP, what's the right rate of charge? Those are the big changes here, which are not in the budget, but are still something that our clients are working through quite carefully. And one more final thing is tax admin and transparency. So we're getting a new consultation on the crypto asset reporting framework and some changes to CRS. So CRS is the common reporting standard, and in the good old days, bad old days, if HMRC wanted to know about a UK resident person's overseas income, they would have to write to the local tax authority, and they could only do so much a year, and it was quite hard for them to find out. Now it's all automatic, and the overseas financial institution provides the information, and most, if a very large proportion of the tax inquiries that we get on our clients are automated. A CRS information has been provided with HMRC, the computer checks it to the tax return. Oh, it's not there. Right, then we'll launch an inquiry. That is very, very common. And there's going to be a similar approach potentially for crypto assets. So they're going to go to the big exchanges, to sort of Binance, to Coinbase, places like that, and they're going to require them to keep information about the UK resident individuals. Well, it's a global initiative, but and then provide that to the local tax authorities. It is described as a consultation in the UCLAR, which is the Overview of Tax Legislation and Rates, which is the big book that we read when we're doing this. But the policy costings document says it's definitely coming in. So maybe not. Don't bother responding to the consultation on that one, lads, because that's again what my children call saying the quiet part out loud, I think. But so it's coming in from the 1st of January 2026. There also is a proposal to extend CRS to UK transactions, so automating financial information provided from UK banks in respect of UK people or UK other people. Finally, thank you for your patience. So what's missing this year? There's a huge amount of areas where we just simply don't have any detail. We don't have any sort of draft technical pages. We don't have a lot of the detail that we normally have, which gives the perhaps erroneous impression that a lot of this budget was quite last minute. And so hopefully that will come over the next year. Nothing on IHT reform. We were all expecting something maybe on that, hasn't come in. We were expecting maybe an SDLT cut, hasn't come in. And the last thing, which I was going to mention, which he did say, was full expensing on leased assets. So the Chancellor did say, we're going to, we've introduced full expensing for purchased assets in autumn, and we want to expend it to leased assets when the finances allow. That's what he said. And so I haven't put a slide on that because, of course, he won't be the Chancellor then. And the missing thing here, really, I would to finish with, is that this is probably the first of 2 of these that I'll be doing this year, maybe even 3, and probably the least important, because the next one will probably be a post-election budget. And looking at the government spending plans, the finances for this budget are based on spending plans which no one believes. No one believes that the Chancellor, Tory or Labour, will make the spending cuts which are required to make the budget numbers add up. So, massive cuts to public services are needed to fund this budget as it currently is. That's not going to happen whoever wins the election. So the next budget, hopefully you'll also join me, will be alive with interest. So thank you very much.